This is an analysis from Alpha Business Media. Now, you've probably heard it 100 times. Nepal's fintech sector is a massive success story. In this analysis, we're going to pull back the curtain on that popular narrative and show you why this story of explosive growth is actually hiding a market that's heading for a major shakeup.
You see, on the surface, having all these digital payment options seems like amazing progress, right? But if you talk to the average user or any merchant in Nepal, you'll find that all this choice has really just created a huge headache. It's a system that's becoming more complicated, not more efficient.
I mean, just look at the numbers. They're incredible. QR transactions shot up by over 1,000% in just 1 year after the pandemic. A number like that just screams success, doesn't it? It looks like a digital revolution in full swing.
But here's the thing. Our analysis shows that this explosive growth is actually masking some deep, structural problems in the market. This isn't just healthy competition. We believe it's the prelude to a crisis, a major market correction where consolidation isn't just a possibility, it's absolutely inevitable.
So let's start by digging into that very paradox, right at the heart of Nepal's fintech boom.
If you walk into any shop in Kathmandu today, you know exactly what this looks like. It's a wall of competing QR codes. And this right here isn't a sign of a healthy market. It's the most obvious symptom of a market that's fragmented, totally oversaturated, and ultimately unsustainable.
So the big question is, how did we even get here? How did the market get so crowded so fast? Well, it turns out it was the result of a perfect storm.
This didn't happen by accident. You had three things come together at once. First, there was a huge, obvious opportunity to digitize cash payments. Second, the regulations were pretty loose to begin with, making it easy for new companies to jump in. And third, investors saw models working in other countries and just poured money into what we call copycat startups, dozens of them, all doing basically the same thing.
And all of this saturation, all this fragmentation, it comes at a huge hidden cost. It's created a problem we're calling the Fragmentation Paradox, where having more choices actually creates less real value for everyone.
So here's the core of that paradox. We've achieved what you might call breadth. We've got millions of people making simple digital payments. But we've completely failed to achieve depth. Real financial inclusion isn't about just sending money. It's about getting access to credit, to insurance, to investments. And this fragmentation is the biggest wall standing in the way of that.
The fallout from this is pretty severe. For you, the user, it means you're stuck in these walled gardens. Your money is trapped in one app and it's a pain to use it with another. For merchants, it's just a nightmare to manage. But the biggest problem, the one that really holds everything back, is data poverty. No single company has a full picture of anyone's financial life, which makes it basically impossible to do innovative things like offer a loan. And this really shows the fundamental design flaw. If you look at a system like India's UPI, it works like a public utility, a single payment highway that everyone can use. In Nepal, it's like every company built its own little private road, and none of them connect. So instead of innovating on top of the payment system, everyone is just stuck fighting a low-margin war within it. Now, the end game for every single one of these companies is to become a super app. But there's a right way and a very wrong way to get there, and this is where most of them have made a critical mistake.
Let's look at the global giants, Alipay, WeChat Pay. They didn't start with payments. They built a massive, engaged user base first with an anchor service, like e-commerce or messaging. Once they had everyone hooked, adding payments was easy. The fintechs in Nepal did the complete opposite. They started with payments, and now they're desperately trying to find an anchor, a reason for you to stick around.
And that, right there, is the entire sector's Achilles heel. They built the payment gateway before they built the city it was supposed to serve. So now, the choice is existential. Either you find a compelling reason for people to open your app every single day, or you're just going to become a simple payment button inside somebody else's successful app.
So, when you add all of this up, it points to one single, unavoidable conclusion. The Wild West grow-at-all-costs era is over. What's coming next is a deep, painful, but ultimately necessary consolidation.
And this isn't just a theory. We see three powerful forces that are about to make it happen. 1. Investors are tired of burning cash on copycats. They're going to start demanding profits. 2. Regulators are going to make it more expensive and difficult to operate, pushing smaller players out. And 3. The biggest players are going to go on a shopping spree, buying up their competitors to build their empires.
We expect this to play out pretty quickly, probably over the next 2 years. First, the easy money will dry up. Then, the rules will get tougher. And finally, the M&A blitz will begin. The whole mindset has to shift from pure growth to pure survival.
And the final result of all this is crystal clear. The crowded market of over 25 digital wallets we see today is going to collapse. When the dust finally settles, you're going to be looking at a landscape with just 2, maybe 3 dominant players left standing. The fintech Hunger Games have already begun. The question is, who's going to win? It won't be the company with the most users or the flashiest app. It'll be the one with the smartest strategy, the strongest anchor service, and the discipline to survive this shakeout. For everyone else, the game is no longer about winning. It's about becoming an attractive target for acquisition.